a sustainable packaging maker, an app for stock trading, a lab grown diamond brand, and even a co living provider. On the surface, India's venture capital scene still looks alive. Deals are happening, VCs are still finding companies to fund, and startups are raising money. But take a closer look, and the final details tell you a different story. Because the truth is that the industry is close to hitting a wall. Let me give you some data to back that up. In 2024, Indian venture capital funds raised a third less from their investors compared to the year before. Only four VC firms managed fundraisers of $100 million dollars or more. And the year before that, this number was 10. And when it comes to actually investing all of this money, things are even worse. In the first half of this year, VCs just put $3.6 billion dollars into Indian startups. And that is the lowest since 2016. And also quite a far cry from the frenzy of 2021 and 2022. So, what do investors do when they're under pressure to place bets, but the pipeline of new ideas has run dry? They turn to familiar faces, repeat founders, or entrepreneurs who've already been through the cycle before. Some with big wins behind them, and others with messy histories, and sometimes both. Because in times like these, the calculation shifts. The risk is not just in backing the wrong founder, it is also in missing out on the next quick exit. So, here is the uncomfortable question for today. If Indian venture capital is running out of fresh stories, are investors being forced to recycle the old ones, no matter how checkered they are? Welcome to Daybreak, a business podcast from the Ken. I'm your host Nigdha Sharma, and I don't chase the news cycle. Instead, every day of the week, my colleague Rahil Philippos and I will come to you with one business story that is worth understanding and worth your time. Today is Monday, the 18th of August. In late June, three of Pharmeasy's co-founders, Dharmil Sheth, Dhaval Shah, and Hardik Dedia, were back in the game. They raised an undisclosed amount for their new venture, an interior design services startup called All Home. Investors included Bessemer Venture Partners, and the company was valued at $120 million. dollars. Now, as most of us know, Pharmeasy itself is a story of boom and bust. At its peak, it was valued at nearly $6 billion dollars and came close to going public. But by December last year, one of its investors marked it down to just $460 million. dollars. And worse than the collapse in value were the reports of the company mis-selling medicines which were documented by the Ken. And yet, here were its founders raising money again. Now, this is not just an isolated case. Do you remember Whitehat Jr.? The coding tutorial company blasted across India with aggressive ads and claims that critics called misleading. Its founder Karan Bajaj faced a lot of backlash, but recently he raised $16 million dollars for his new startup called Complement One, which focuses on lifestyle modification for cancer patients. The backers this time include Bloom Ventures and Owl Ventures. The funding made Complement one of the most valuable seed stage companies around. So, why would investors jump in again? One word: exits. Bajaj had delivered before. He sold Whitehat Jr. to Bajaj in 2020, less than 2 years after founding it, for $300 million. dollars. His investors made a fortune. Nexus Venture Partners booked 4 times return. Owl Ventures walked away with over 10 times, and now Owl is back betting on him again. So, what is the lesson here? That venture capital is not just about whether a company succeeds in the long run. It is about whether you, as an investor, can get out in time. That is why even spectacular flameouts like Baiju's are not cautionary tales for everyone. At its peak, Baiju's was valued at $22 billion. dollars. Now it is essentially worthless. But some investors cashed out before the fall. Times Internet reportedly made 10 times its money. Peak 15 Partners, also then called Sequoia India, sold its share early enough to make 7 times the returns. And the same game played out at Oyo as well. In 2019, both Peak 15 and Lightspeed Venture Partners sold part of their stakes to founder Ritesh Agarwal. Lightspeed made 35 times, Peak 15 made 20 times. Oyo has stumbled since with three failed attempts to go public, but those investors were already long gone. In today's market, where fresh ideas are scarce, old faces and their proven ability to generate early exits looks like the safest bets left. But those bets don't always work out. For more on this, stay tuned for the next segment. Take Blue Smart Mobility, the electric ride hailing startup. Its co founders, brothers Puneet and Anmol Singh Jaggi, also ran Genzol Engineering. Within months of launching Blue Smart in 2019, they took Genzol public. And that move should have made investors cautious. Mutual funds avoided Genzol, but not Blue Smart's backers. Even energy giant BP came on board. And the red flags kept piling up. In late 2023, Genzol announced that it would build a two-door, two-seater EV, a claim that seemed far-fetched even then. But instead of walking away, investors doubled down. In March 2024, the Ken flagged irregularities in Blue Smart's car leasing agreement with Genzol. Just 3 months later, Blue Smart raised another $24 million. But by April 2025, the truth came out. SEBI reported that the Jaggi brothers had diverted funds from Genzol for personal use. And what happened to the supposed EV factory near Pune? Inspectors found that only 2 or 3 laborers were on site and there was no manufacturing happening at all. Pharmeasy's story also shows how messy these bets can get. Over the years, it merged with MedLife, bought diagnostics company Thyrocare, and acquired hospital supply chain startup called Acnomed. Now, to fund the 4,500 crore Thyrocare deal in 2021, Pharmeasy borrowed from Kotak Mahindra Bank. And to repay Kotak, it borrowed again from Goldman Sachs. And when it struggled to repay Goldman, billionaire Ranjan Pai stepped in with an 800 crore rupee lifeline in 2023 at a valuation down 90% from its peak. Meanwhile, Pai's co-investors at 361 Asset backed Make-O, a chain of dental and dermatology clinics. And one of its founders is Arpi Mehta, who is the wife of Pharmeasy CEO Siddharth Shah. But Make-O's valuation has also halved, dropping from over 2,000 crore rupees in 2024. And then there is Rahul Yadav. He clashed with investors at his first startup, Housing.com, and was eventually fired in 2015. His second company, 4B Networks, raised 290 crores from InfoEdge. By 2023, InfoEdge had written off the entire investment and even filed a criminal complaint against Yadav and other executives, accusing them of misusing funds. Patterns like these should make investors wary. But the reality is that they often don't walk away. Because in a market starved of fresh opportunities, a founder with baggage can still look like a better bet than no founder at all. And that is the paradox of Indian venture capital right now. Even when the past screams caution, the present keeps pushing investors to roll the dice again.
Daybreak is produced from the newsroom of the Ken, India's first subscriber-focused business news platform. What you're listening to is just a small sample of our subscriber-only offerings. A full subscription unlocks daily long-form feature stories, newsletters, and podcast extras. To subscribe, head to theken.com and click on the red subscribe button on top of the Ken website. Today's episode was hosted by Snigdha Sharma and edited by Rajiv CN.